It's my distinct pleasure today to talk to Salam Sanders, one of the principals of SG Real Estate. It's good to see you today, Salam.
Thank you, Pat, for having me on Forefront.
In the real estate industry, I'm curious right now. Interest rates are rising, and I'm wondering if your investors have a higher yield expectation. And, secondarily, have sellers of properties, which you're always in the acquisition mode, willing to adjust their expectations?
Yes, the interest rate environment has been extremely challenging. Our investors aren't changing their expectations on their returns, but they are expecting that we meet the returns that we promised. So it's been extremely challenging navigating this market with rental rates increasing at the rates they were. However, with expenses now being what they are, well past indicated pro forma rates at the time, it's just been a challenging navigating that fine line. Our investors understand the climate, and we work with like-minded individuals who know what's best for the asset. Fortunately, we've been extremely successful navigating this difficult time. But no, expectations haven't changed, but we're definitely going to deliver what we promised.
My next question is I'm curious, because we have a lot of also consumers who look at this information that we put out, and inflation is a big concern. And so I'm wondering, have rents been increasing with the rate of inflation, and how has that been impacting your economics?
Rents have far exceeded the rate of inflation. In 2021, I believe we saw a 22% rental increase across the nation. Year over year at this point, we're still 7% above where we were last year. With rental rates increasing like that, on top of that compounded with inflation for residents, this is going to be a very challenging winter and first quarter. Our strategy is to buckle down, hunker down, watch expenses, focus on retention and retainage to help minimize transition and turnover, while being very in tune with the market demands, not overestimating what the market can tolerate, but being intentional with our market rate adjustments, minimizing any promotions and specials we might need in the slow period.
I have also today Deron Sanders, who is running the energy portion of the SG companies, and looking at acquisitions all over the place. And so switching gears, Deron, you're hooking up alternative energy sources in your energy company. And I'm curious as to how is the market adapting to new energy?
So Pat, that's a good question. The market is adapting in a couple different ways as I see it. And one of the things that I think is a positive for the market is we're becoming more and more aware. The technology associated with where EV charging stations are for folks that are trying to get across the country, as an example, is becoming much more prevalent. So that's one positive. We're also seeing that as the demand increases, the supply chain has gotten a little bit better. Where we're not seeing as much market change is in terms of the raw materials. If you think about what it actually takes to produce an EV charger or even an EV car, lithium and cobalt are two of the primary raw materials. Where if you look at U.S. production or extraction, I should say, we're very, very limited. And if you look at lithium specifically for lithium-ion batteries, the U.S. actually extracts about 1% of the total lithium based on the demand or whatnot. And that's a very small percentage. And when you look at some of the larger countries that actually extract it, you have Australia that extracts at a level of 52+%. You have Chile that extracts at about 21%, and then China coming in a distant third at 9.7%. So I think where some of the lag is U.S. production and or extraction of lithium and cobalt. And on the cobalt side, that primarily is mined in the Democratic Republic of Congo. And there's huge ties between Russia as well as China. And so when I think about the connection between the United States and raw materials and the supply chain that follows through all of that, I think we lag to some extent on our ability to be able to extract the raw materials that are so needed.
Do you see a lot of growth in this industry? And I know you're immersed in it. And I'm curious, if you do, why? And then do you see any potential headwinds going forward?
Yeah, so I do see it as a growth industry. I mean, if you look at Europe as an example, and these are some of the headwinds I'll start with. Europe and the U.S. following Europe has put together policy and mandates that actually dictate that certain regulations are adhered to over the course of time. And so when I look at that as one of the potential headwinds in the United States, we're seeing a lot of activity associated with that. And then you have microcosms of those mandates in areas like Los Angeles that doesn't, allow for production of fossil fuel or gas-powered vehicles, by 2030. And some of those things, whether you like it or not, are going to be headwinds that ultimately create additional demand in the market for EV charging stations and EV automobiles. The investment tailwind is another that's come about. I mean, starting with the federal government that has made numerous announcements over the last several years, including with the Biden administration's mandates that were alluded to earlier. You see a lot of investment being made, not only by public and the federal government, but by private partnerships and private companies specifically. I think not too long ago, maybe a year or so ago, GM announced a $20 billion investment in the EV market. And then lastly, you've seen market demand and market drivers that show how companies like Tesla, that within the last year or so, and it's gone up or down, but their market capitalization has been more than the top 8 automotive manufacturers combined. And so if that gives you any indication of where the market is heading from an EV standpoint, the future seems to be bright.